QuickBooks Online 2026, creating and analyzing expense and vendor reports. What are they? How do we use them? When do we use them? Well, get ready and some coffee because we're moving on up with QuickBooks Online 2026. Searching for the free QuickBooks Online sample company file as we do every time. Simply typing into our favorite browser, QuickBooks Online Test Drive. Looking for that result that has Intuit.com in the URL, Intuit being the owner of QuickBooks. And then, can you believe this? The QuickBooks Test Drive is trying to say that we have to give it some stupid verifications that we're not a robot, Ara.
Oh, please. If I was a robot, would QuickBooks stand a chance against me? Our AI has already taken over. The singularity is complete. Bow before your .com owner, Intuit.
That's right, Intuit. Intuit, you best back off. You don't know who you're messing with. All right, I don't need to give no one no credentials. Tell anyone I'll be whoever I want to be. Reports on the left-hand side, and then we're in the favorites. We're going to be right-clicking on that balance sheet report, open a link in a new tab as we do every time. Right-click on the profit and loss report to open a link in a new tab as done every time. Let's tab to the right so we can close up any pop-ups and then change that range to 2025 because even though we're in 2026, the data as we know is still in 05. So let's go from 010125, not 0525, to 123125. And then let's go to the tab to the right and repeat the process. The range should be the same, 010125 tab, 123125 tab. All right, now we're looking at other reports other than the main financial statement reports, this one being expense and vendor reports, remembering that if we look at the balance sheet, then the accounting equation is the balance sheet, assets equal liabilities plus equity, which can also be represented as assets minus liabilities equals equity, equity being the book value of the company, what the company has minus what is owed to others, similar to the equity in a home, for example. And then the story of the creation of that equity is the income statement, looking over here, where we have two primary types of categories, income and then expense type of accounts. So all other reports other than these major two financial statement reports are generally giving more information about one or multiple line items in these two major financial statement reports. This one, clearly called expenses and vendors, you would think would be giving you more information about the expense line item on the income statement. Now, the idea of vendors would mean, maybe that might be like accounts payable that it is talking about as well. But the accounts payable stuff was mainly in the who you owe category, the accounts payable category. So you would think we're talking expenses and vendors on the income statement side of things. So remember, the income statement is a timing statement. Both income and expenses are going up in their relative directions. They never go down unless there's some weird thing happening, unless or until they get closed out, similar to driving an automobile for like a week. The odometer always goes up. It never goes down. Even if you try the Ferris Bueller thing and put it in reverse for a long time, it doesn't work. The odometer still goes up, and that's how it works unless you were to reset the odometer at the end of a time frame somehow and then do it again, which is what happens with the profit and loss. The income is the goal of the business. That's revenue generation that measures performance. How well are we doing? Well, we can gauge that. One measurement, the best measurement we know of, is with dollars. How many dollars are we taking in? And the expenses represent the consumption of things we need to generate revenue. Now, obviously, when we have revenue, we have to do something to generate it. So we're doing something virtuous in the world. That's what businesses do. They create virtue in the world by working, and they generate our revenue. So whatever we do to generate the revenue, like our example, driving the car, we might get paid by mile to drive the car for so many miles or whatever. And then the expenses are what we incurred in order to do it, such as gas and oil and so on and so forth. Clearly, we need to measure the gas and oil and so on and so forth, not in gallons, but in dollars as well. So we have apples to apples, one unit of measure compared to another unit of measure, and then we can measure our performance. How good, how efficient were we in generating the revenue by mitigating the loss in terms of the energy lost of expenses, revenue minus expenses. Now, the different categories of expenses are going to be larger than any other category typically on both balance sheet and income statement because we pay for everything that we don't specialize in. So that means everything that's part of the business that isn't what we do, we're paying for, and we're going to give a category for that particular thing because we want to measure how efficiently we are using that particular thing for the goal of revenue generation. So that means all the expenses are in here in category of what we used them for, similar to income by category in terms of what kind of income we generated. So you can imagine, similar to income, possibly being wanting to be broken out by who gave us the income, customer, or by what we sold, the product or service. Then over here, we want to also possibly break this out by vendor. So you can imagine possibly doing all of your expenses into one line item and then saying, like we did with the income, and then saying, I don't care what expense category we expended on, I want to break out who we paid, the vendors that we paid by total expenses, getting in essence a subledger by the total expense line. So that's one way that you might see it. It's not as common as the revenue side of things because that's the goal of the business. So it's more common to want to break things out by income in terms of customer and then product than it is possibly to want to break out your expenses by what it's already as efficient as most people need it by account. But you can imagine wanting to break out all expenses by who you paid, vendor. All right. So one way we could do that is we could go up to the top here and say, I want to break out a column by vendor. So instead of going quarter by quarter, for example, up top, comparing period to period, I've got all the vendors. Doesn't make any sense for the income side of the report, but on the expense side of things, then now we have both who we paid and the account that was paid for, right? And so that's kind of cool. And I could collapse the expenses here so that we then have basically a horizontal kind of breakout type of report, all expenses being broke out by who we paid it to. All right. However, it's more likely that we're going to make another subsidiary report, which would be in a vertical standpoint. That's typically kind of how we like it, in a column, so that we can do our kind of analysis, possibly making a pie chart from it, exporting it to Excel and whatnot. So let's go back to the standard and let's go to the first tab and analyze this section of the reports, the expenses and vendors. So where are they? Favorites, business, who owes you, that's the accounts receivable. Inventory is on the balance sheet. Sales and customers, that's the top side of the income statement. What you owe, that's the accounts payable section typically. Now we have expenses and vendors. So that's clearly going to be the income statement side of things for the people that we paid, the vendors. What do we have under here? We've got the check detail. Now that seems kind of weird because you're like, okay, check detail. Shouldn't that be in some kind of business overview report or on the balance sheet side of things because it's a balance sheet report? And it's like, yeah, but you can kind of think of it here because you would think that the things that we paid, the outflow of the money, eventually would be for goods and services that we purchased for the most part, whether that be straight through the bank feeds, meaning we record expenses through the decrease with the bank transactions, or they go through accounts payable. This check detail, you can imagine, it's basically going to the balance sheet, and we can imagine running a similar type of report by just simply going into the transaction detail for the checking account. The checking account is going to have just simply increases and decreases if we were looking at a bank statement, but it's more complex with these transactions because the names, particularly of decreases, will be specific depending on what we paid for. So in other words, we've got, these are all the decreases, bill payment form versus expense form versus check form, and so on and so forth. So you might try to order it, first by date and then by transaction type, but it kind of groups them all together by form is the typical way we're going to see it. The other way you could try to do it is by date. Do it first that way and then by date. No, that's not going to work. Or you could filter it. I could filter it over here and then add a filter of the transaction type and get a similar kind of report. All right. I won't do it now, though. Let's close this out. Let's go back. Let's go back to the first tab. So then we've got the 1099 transaction detail report. Now, this is, again, we saw these 1099 reports, some of them up here. So they don't really seem to know exactly where to put the 1099 reports. Those are reports for taxes in the United States. You will recall the general idea is we have an income tax system. So the IRS wants to make sure they have their claws in the business and no one's flying under the radar. So for large companies, the IRS typically has their claws in them. They feel that they're going to be in compliance. It's in their best interest to be in compliance. For individual sole proprietors, however, then that becomes kind of a problem. If they are not incorporated, the IRS is suspicious that they're going to try to fly under the radar. That means when you pay someone, if they're a corporation, then you're probably good because you don't have to report the income that goes to them. But if they're not, then the IRS would like to make them an employee of yours, forcing you not only to report the income that you're giving to them, but also to withhold that income and pay it on their behalf so they never get to touch that part of their own money. Or if not, then they want a 1099 contractor situation where you have to tell the IRS, hey, these people got this much money, make sure that they report it on their side. I want to make sure that I can get the expense on my side. So we'll talk about that a little bit more later. It's just a tax-related thing. Purchase of products and service detail. So now we have the purchases specifically of products and services. So this is more of like an inventory related item than kind of an expense related item, because on the income statement, it'll finally go into cost of goods sold. But let's open that up. Let's right click, open that in a link, new tab, open purchase order detail. Now this is another kind of vendor report because hasn't hit the income statement. It's more like an inventory report. You would think they might put this in the inventory section. They probably doubled it up. I think we saw it up there as well, and possibly down here too, because it's dealing with the request of inventory. So a purchase order has no impact on the financial statements, but needs to be tracked in a similar fashion as an estimate so that when we get the inventory, we can make sure that the order matches what we got, noting you would only use a purchase order if you have more power in the negotiation, the situation. Otherwise, like us normally buying from like Amazon or some on-time online retailer, we would have to pay for it when we request it, as opposed to requesting it, having it shipped to us, and then paying for it, right? Which is where you would have a purchase order. Purchase order list, and then the purchase list. So this is going to be, the list of purchases for typically inventory. Transaction list by, right? That's right. Transaction list by vendor. So now we have all the transactions broken out by vendor. Let's open that up. Vendors are the people that we pay for, typically when we do recording expenses at that time. Purchase by vendor detail. Let's open that up. Right click and open that one up. So similar, but with a detail. And then we have the vendor contact list. So this isn't really impacting the financial statements. It's just going to give us the phone and contact information, noting most businesses might not have that information or too much in the vendor contact list. Because do you really have that much information about Verizon, your phone company, or your utility company? No, you just have their name and where to send the electronic transfer to. That's basically it. You don't even have their address anymore, typically. But if you have inventory or something like that, you're going to want to cultivate a more significant relationship that might be more personal, contact information possibly being more necessary in that case. Expense by vendor summary. So here's the one that we were kind of thinking of as the primary one in this category. And then we got the vendor list, which is just going to give the phone list for the vendors, which is, again, contact information. So this would be the most common one. Let's pull it over here. So the first one that comes to mind when we're thinking about expense and vendor reports, in my mind at least. So let's go ahead and change this from 010125 to 123125 on the range. So now we've got the vendors broken out, and then we've got the total at the bottom. What is this totaling out to? Well, you would think that it's an expense by vendor. It would be totaling out to the profit and loss line item of expenses. But wait, expenses have all kinds of line items, accounts under them. So it's not really one account, it's the account type, the summarized expense line item, the bottom line total that you would think it would tie out to. $5,237.31 versus $8,232. All right, so we have a difference there. Possibly we've got the cost of goods sold in there as well. Okay, so no, this amount on the expense by vendor summary is way higher than what's on the profit and loss. So you would think, what would that mean most likely, or why would that be happening here? It's most likely because the expense report is reporting anything that got paid to the vendor, whether it was an expense or it was anything that we purchased, inventory, that in this case is going into like a job cost kind of system as well. So the bottom line would generally be the idea that, well, if you were doing a very simple cash-based bookkeeping system, then you would think this report would tie out to what's on your profit and loss for the most part, unless you bought like property, plant, and equipment. Otherwise, this report is showing kind of cash outflows or outflows that were generated, I believe, from like an expense form or a check form or like a bill form. And so there's like an accrual kind of problem. Therefore, ideally, if I'd like to use this form, I'd like to be able to reconcile it, which you might be able to do by going, say, for example, to the balance sheet and then taking a look at the difference. For example, going to this drop down and say, I want to look at the previous year and the change. Now, in this case, there was nothing in the previous year, and maybe the difference would be, say, the inventory. Now, and also you could have something happening with like the truck, because you might have bought like part of that property, plant, and equipment with the expense forms. I'm not going to go into it in detail here because they kind of cheated and fudged the numbers a little bit as they entered the inventory and did adjust payments to inventory to show the adjustments of the payments and whatnot. But the bottom line is we would think that this would be the amount that's basically recorded by, you would think, bill forms, expense forms, and check forms, credit card expense type forms for mainly expenses, but also possibly could use those same forms to be purchasing inventory. Not exactly on a cash-based system here, because we still have the bill forms included, but that's going to be the idea. For example, if I go into the Hicks hardware, just to show you what I'm talking about, then we're going to go into here and we could see the transaction detail, and you can see the forms, type of forms that are included in this number. Expense forms. So that's usually where we purchase something, and usually the other side is an expense, but in this case it's not, because if I go into that, then this is going to be the job cost. Now that I think that's going to be going into a job, which would be a type of work in process inventory, possibly not having hit the income statement, and when it does, it'll be in cost of goods sold, not in the expense area. So here's the credit card. So this one, we didn't buy it with cash, we bought it with a credit card, but it's still an expense form. Here's a bill form. That's the accrual form. So now it's including it here. We bought it on an accrual way, possibly haven't yet paid for it, right? but we're not. So that's why it's not exactly a cash-based system. It's recording what we purchased, but what we purchased likely would be an expense for many businesses, but could also be property, plants, and equipment, or say inventory. All right, so let's go back. Now, this report would be a beautiful report to just simply export to Excel and make into a pie chart, because you can just run a running balance total and form it into a pie chart. So could do that. It's possibly not as common to do that with the expenses as it would be to do with the revenue line item. But you could certainly do that, and then you would want to explain exactly what that number kind of means, possibly being able to reconcile it. Otherwise, you could do it with this number. Like, I could break this out this way and then say I want to see it by vendor, and then possibly simply collapse the expense line item and then export this report to Excel and just look at the total expense line item. And that way, again, you'd have to trim up the report a lot, and it would be in a horizontal fashion instead of a vertical fashion, but you could still simply take these numbers and do a running balance on it, which would tie directly into the sum of the expense line items by vendor right up top. So that's another option if you wanted to add another kind of report that ties directly into what's reported on the profit and loss, and do like a pie chart with it or something, which would be pretty easy to do once you did it a few times. And so probably not done by others. So you can kind of impress people a bit. We have then the transaction list by vendor. If you change the range 010125 to 123125, then that's going to be here. So that's going to give us a drop down of the transactions, of course, by vendor. So we're going to have the detail of what has taken place during that period by vendor. Noting it's not just going to record, as we saw in the expense by vendor report, the increases, meaning it's not just recording the bill forms. It's also got the credit. It's got increases and decreases in it, right? So here's the bill. Here's the bill payment form is being included in here. These two netting each other out. So here's the two bill forms. Here's the payment. So it's kind of showing the detail by vendor that you might see in the vendor center. Now, you might not want that, right? I might want the detail of just like the increases, so that this possibly would tie out to the expenses by vendor, for example, right? And you may be able to filter that. If you wanted to toy with the filters over here, you might be able to add, say, a filter and say that we wanted to filter by a number, and then we want to say that it's going to be equal to, not equal, contains, is not empty. Let's say it's going to be, so let me change that to amount, and then I'm going to say I want it to be less than, and then
zero.
We'll say 0, right? Less than 0, and then say, okay, see what happens there.
Amount less than.
All right, Ara, I got it. All right. So now we've got the checks. This is the checks and so on, and then this totals out to 6005. So this isn't still going to tie in exactly to the expense by vendor, because it's showing just the outflow. So now an expense form is an outflow that is happening, or outflow from the checking account. But the bill forms, which would normally be increasing this expense by vendor report, are being recorded here as positive. And then when we pay the expense with the bill payment, it's going to be negative. So I could further use the filters by transaction type to try to kind of play with this, but that's just a way that you can kind of play with the filters on the transaction list by vendor. Let's go to the purchases by vendor, and we'll add 010125 to 123125. So now we've got purchases by vendor. Now the purchases are going to be the purchases typically of inventory. So this is going to be the inventory information, 1,005.6875. Now you would think then that these inventory purchases are using they're using check forms, bill forms, and then you've got all these inventory quantity adjustments. So, and they put those in place to put the beginning balance of inventory in play. So you would think that part of our difference between the profit and loss here the profit and loss in the expenses adding to 5,237 and the expense by vendor 8,232 is going to be with in this purchases of inventory, because they're still going to be made with check and expense forms paid to a vendor of 1,568. So that might be part of the difference. But again, I'm not going to get into detail for reconciling it at this point. It's just that the purchases by vendor are typically not going to be service items, which are typically expenses or things that we're going to expend or things that we're going to consume in the same period. We're typically talking about inventory, and that means that we have an inventory item that you have put in place, and that means that you're typically tracking inventory more on a perpetual inventory system, tracking units of inventory for the most part. All right, then let's go to the purchase by product details. So we're going to say this is going to go 010125. Que paso 010125 010125 to 123125, and then purchase by product detail, purchase by product / service detail. So now we have product and services for the details, and again it's breaking it out this time not by vendor as we had over here, but by product. So now we've got the fountain and the landscaping and so on in the detail. I believe we saw this in another section as well in the inventory type of section. But the idea being here, they put it in the vendor side as well, because we're dealing with inventory items, but still paying vendors.